Welcome back to the Dividend Diplomat YouTube channel. You know you're on with your boy Bert over there. Look at him doing the hand gestures. And you got your other dude, Lanny, the Dividend Diplomat. And guys, here we are. We're talking about two high dividend growth stocks to potentially buy right now as we close out 2021.
Yeah, absolutely right, Lanny. But everybody, before we do, help us out before the end of the year. Please subscribe to our channel. Give this video a thumbs up. We are loving how many of you are interacting, commenting on our videos, and spreading the word of dividend growth investing, because that's what it is all about, building a community that together is going to pursue and eventually achieve financial freedom.
That's what it's all about. And these are two high dividend growth stocks that can easily and most definitely increase your passive income year after year after year after year after year after year. Now, these two companies both have actually increased their dividend for over 9 years. And Bert and I, we would consider these two of your lower yielding but significantly higher dividend growth stocks. So when you think of the seesaw, typically the higher the yield, the lower the growth, or the lower the yield, the higher the growth. So just always think about that when you're buying dividend stocks. Again,
because that's important, Lanny, because we don't chase yield here. We always look for that combination of dividend yield and dividend growth, and to make sure that seesaw is functioning how it is. The situation you do not want to have is a low dividend yield stock and a low dividend growth stock there. That's what you want to avoid.
Yeah, you want to avoid the old 3M, the old Emerson, anything that yields into that 1 to 3% that grow their dividend by
AT&T after that dividend cut. I'm kidding. That was a joke, everyone.
But
you're right, Lanny. You're absolutely right. There is a population of those companies that you look at and you're just like, oh, I just wish the growth were higher for that yield level. And that's where we want to avoid.
So we're here to talk to you about two stocks right now. Two stocks that potentially show an undervaluation in this all-time high stock market.
Cool.
Bert, the S&P 500 almost hit 4,800.
Yeah, all-time stock market is an understatement. Man, wait, didn't it feel like 2 weeks ago we were talking about how the market was going down? It was going to cross below 4,600 and keep heading down, and we were going to be scooping up undervalued dividend growth stocks like crazy.
I do stand corrected. It did touch 4,800 this past week.
Yeah, a little kiss at the top there, 4,800. That's insane, man. What? This month, the market's up almost 3% after what has been a seesaw month for the market. Yeah, it's finishing 2022 strong.
Exactly. Finishing it strong, trying to reward the investors in the stock market. But we are looking at two undervalued stocks. Again, let's get right to it. We're looking at three metrics: the price to earnings ratio, the dividend payout ratio. Third, that dividend growth rate, that growth rate on average. How many years have they juiced up that passive income stream? And then we're going to talk about the dividend yield, which really does pertain more in this analysis because it helps parlay with what the dividend growth looks like. Now, Bert, this is an industry that I know, technically I don't really have any investments in. How about you?
No, not really. I'm kind of with you on this one. So when we saw these companies talking about, we're excited because you know what? We're not just peddling these companies there just to get views and tell people stocks just, these might look at. We're doing the digging and we want to potentially invest in these industries and these companies as well. So the results of this, hey, maybe we'll find something on our January 2022 watch list to add. That's the beauty of what we're doing here.
And there's definitely one stock out of the two that, you'll see I may be adding to my at least stock watch list. Mm-hmm. And, I actually already have another video in mind for another part of an industry that I know we both don't really have. So it'll be another solid video. But today we are talking about the health insurance care provider industry. And Bert, what are the two dividend growth stocks we're talking about?
This is the anthem. Throw all your hands up. Yeah. No, I'm kidding. The first company is Anthem, ticker symbol ANTM. Who's that second company, Lanny?
Second company is United Healthcare Group. UNH, two of the biggest in the industries. And it's funny, over here in the Laney household, I have Anthem and my wife has United Health. Bert, what about you?
Oh, my wife works for a hospital system, so we use their own hospital system health insurance there. So no ticker getting traded there for that company. So I'm unbiased, but that doesn't mean we're not going to look to invest in our household in these two companies based on the results of this analysis.
And for those that are curious, it's actually cheaper for me not to be on her plan and just being individually on my own plan.
The question that everybody was asking here into this video.
Everybody wanted to know about that. All right, so guys, we're going to run them through the stock screener, the Dividend Diplomat patent pending stock screener. So Bert, what's Anthem look like on that first metric, the price to earnings ratio?
All right, prices are as of December 28th, 2021 here. Their price, $464.21.
Well,
I know. I mean, this industry might need to have some stock splits happening soon at this point with where these share prices are going. Forward earnings, $28.65. That gives you a PE ratio of 16.20.
that's pretty good.
Yeah.
Oh, yeah, low. That's pretty low.
Yeah, especially compared to market. Well, now that the S&P 500 is about to hit that 4,800, but ready to break through there. We were saying the forward PE ratio was always between 25 or 30. We might need to bump up our little range we talk about to a 28 and 32 here based on where this market's heading.
Exactly. And to dive into United Health or UNH, we thought 464 was a high stock price. Well, UNH is trading at $502.94.
My gosh, Lanny, my gosh. You know what these companies do? They need to take it easy. Hey, take it easy.
Hey, you take it easy. You take it easy, stocks. So the forward earnings projections from analysts are $21.65. So it's pretty interesting. Higher stock price with a lower expectation. So that's going to equal out a much higher price to earnings ratio at 23 times forward earnings. So much 50% higher almost than Anthem.
All right, it looks like Anthem's that clear winner here of that first metric when you put the two of them head to head. Moving into that second metric here, that dividend payout ratio, Anthem's annual dividend is a blistering $4.52 per share. Divide that by the 28.65 forward EPS that we are using. Payout ratio is only 15.78%. Woo-wee, Lanny, that is way below our 60%. There is plenty of room to keep growing that dividend going forward.
Plenty of room to juice it by double digits going forward. United Health, pretty similar. They pay a $5.80, per year dividend or $1.45 per share per quarter. Taking that 580 over the 2165, we are dealing with a nice payout ratio of 26.79%.
Fantastic. Both companies look excellent with this metric here. So two big check marks for Anthem and United Health. Let's move into number 3 here. All right, the 5-year dividend growth rate for Anthem is 11.86%, and they have increased that dividend for 9 years. Double-digit dividend growth rate. Can't really complain about that.
Wow, almost at 10 years, doing it in a double-digit style. And Bert, I wanted to mention Anthem actually this past year increased their dividend 19%. So much better than that 5-year average.
Yeah, no, it's a great drop in here. How was United Health's average growth rate and the year's increase?
The average growth rate's a cool 18.73% on average over the last 5 years, doing it for 11 plus years. But Bert, what was the difference with United Health? What was their recent dividend increase?
Oh man, it was just a pathetic 16% increase in their dividend this year. Anthem blows it out of the wall. I'm kidding. It was excellent. 16% is great too. It wasn't quite at their 5-year dividend growth rate, but an 18% 5-year dividend growth rate is fantastic on its own. So a 16% last year. I'll take it.
They'll take it. Now, Bert, get into that bonus metric. This is really going to show the higher dividend growth rate, because Bert, what does that fourth bonus metric, that dividend yield, look like?
Dividend yield is only 0.97%, so it's below the broader market. But remember the seesaw we talked about earlier: low dividend yield, high dividend growth rate. That's what we want to see. So it meets what you want to see for a low yielding stock.
Yeah. What about United Health, B?
All right, it is. Oh man, it blows it out of the water here, Lanny, with a 1.15% dividend yield. Oh my, holy cow, man!
Oh man, oh boy, oh Jesus.
Same
Now,
trend though, higher yield, slightly higher yield, even higher dividend growth rate. That's, I mean, again, both companies exactly the trend that you want to see for low yielding stocks.
owning these companies for at least 5 years, your yield on cost or your YOC would significantly increase at a fast rate. Again, if you're a buy and hold investor. So if you're a beginner investor looking to own something for the long term, here's a good dividend stock for you to consider, because your yield on cost would considerably go up year after year with these increases. Now, Bert, a little bit about the stock performance this year. They have both increased their stock price year to date almost 45% each. And it's pretty much obviously the same thing on a 1 year basis. So they've been on fire.
Yeah, and I mean they're crushing the S&P 500 that's increased almost 30% year to date as well. So I mean, it's just they're firing on all cylinders. There's nothing more to really say. They're outperforming the S&P 500. Enough
Yeah.
said. There's nothing really more to analyze.
To quickly talk about the actual financial performance too from the operations, both Anthem and United Health, their revenue is significantly up versus last year. The last Q3 quarter saw revenue growth of 16% for Anthem, and it was still an 11.5% growth for United Health. When you actually think of enrollments for Anthem, that was also up 5.7%, serving over 45 million people. Year to date, Anthem's revenue was up 13% versus United Health's at 11.6%. But Bert, there's a certain ratio that I and we also look at from a liquidity standpoint. What does the current ratio, again, which is your current assets over current liabilities, what does that look like?
Yep. So again, you typically want to see a current ratio over 1 to show that you have enough current assets to cover your current liabilities. Anthem's current ratio is 1.47x. United Health's current ratio is 0.77x. So yeah, I mean, obviously it's not at 1, not that low either, but when you're looking at the results here, strong revenue growth, strong enrollments for each of the two companies, the one thing that sticks out as the big difference between the two is that current ratio between Anthem and United Health.
And you know how busy they've been, because I believe there's still processing going on with all the COVID-19 events or items within these healthcare groups. And one would argue that, earnings could also be up if nobody was able to submit claims because of the inability to go to a hospital system. So
That's fair. So here, before we get into the final analysis here, let's just summarize the two stocks quickly. I'll kick it off with Anthem. PE ratio 16.2, payout ratio 16%, 5-year dividend growth rate nearly 12%. They've increased that dividend for 9+ years with a yield of 0.97%. United Health, Laney, summarize it, lay it out there for us.
UNH, a price to earnings ratio of just over 23, a payout ratio below 26%, dividend growth rate of just about 19%, growing for 11+ years, and a dividend yield at approximately 1.15%.
Both companies are performing well here when you look at the two of them side by side. Again, the one big glaring thing is kind of similar to that current ratio between them. The one thing that is a major difference between the two of them is the PE ratio, where Anthem's PE ratio is significantly lower than United Health. A 16 PE ratio for Anthem versus United Health at 23 shows that, just looking at the pure numbers, they are trading at a lower multiple and at a cheaper valuation compared to earnings compared to United Health.
I agree, Bert. I'm here to tell the community that I really like Anthem. It's not like me to want to buy a dividend stock or buy a stock that has a low dividend yield, but that's usually because that PE ratio is always high. When you think of the Apples of the world, or the
Even
Nike,
Visa, Mastercard.
yeah, Yes, 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 and yes.
And where
Whereas,
you see that yield that's below 1%, but the PE ratio in the mid to high 20s, kind of probably similar to what you'd see for United Health when they're looking at that metric. That kind of measures, in my mind, it tracks with what you'd expect for a low yielding, high growth rate stock.
so Anthem is honestly, looking very appealing right now, and they're going to be on my dividend stock watch list right now as we head into 2022.
Excellent conclusion. I can't disagree. I think that's fair. Add them to the watch list. See what happens as 2022 starts. So everybody, let us know what your thoughts are about Anthem, United Health. One company, are you watching one? Are you watching none? Are you looking in different sectors? Let us know. It'll be very interesting. And obviously, too, let us know if there are any other stocks, sectors, industries that you want us to start analyzing here in the coming weeks. We're always looking for suggestions because we want to buy income producing assets ourselves too. So let us know what stocks we should be looking at.
Yeah, let us know what stocks are, you're looking to buy as you head into 2022. If you haven't already, definitely subscribe to the channel. Please don't leave without giving this video a thumbs up for Bert the Hurt and I. Again, that was Bert, and this is Lanny from the Dividend Diplomats. Over and out.